Hi there, Jared Roboski here with CMG Home Loans. Just wanted to cover the best strategies for today's real estate market. So let's jump right in. So what we're going to cover here are the challenges, strategies, temporary buy down, permanent buy down, adjustable rate mortgage, loan assumptions, education, and a question and answers. So the challenges in today's market is higher rates are decreasing affordability, right? Houses not selling, creating sellers to panic a little bit and dropping prices. There's fear of a market crash, and then there's a lack of buyers. So the best strategies to overcome these challenges are going to be the temporary buy down, the permanent buy down, adjustable rate mortgages, loan assumptions, and the number one thing is education. With proper education, we can show why now is actually a fantastic time to buy with all of these strategies available to us. So, the mortgage rate buy down. You can lower your mortgage payment with either a temporary rate buy down or a permanent rate buy down. So, a temporary buy down is you decide how many years you want to lower the mortgage payment, 1, 2, or 3 years. Mortgage payment will be based on an interest rate 1%, 2%, or 3% lower than the original rate. And then the rate will increase 1% annually until you're at your final original rate. Now, the permanent rate buy down is the use of credit to buy your rate down permanently over the entire term of the loan. The credit can be used to pay for other settlement costs, to lower your cash to close, or to invest into your home, or to pay off other debt accounts. So this is what a 3-2-1 looks like. It's offered on a FHA, VA, USDA, or conventional loan. So it's going to start 3% lower the first 12 months, then 2% lower the next 12 months, 1% lower the next 12 months, and then after that you'll be at your final rate. So a 3-2-1 buy down mortgage is a type of loan that charges lower interest rates for the first 3 years. In the first year, the interest rate is 3% less. In the second, it's 2% less. In the third, it's 1% less. After that, the borrower pays the full interest rate for the remainder of the mortgage. So what does that mean? Let's check this out. So here's an example. This example is based on a $715,000 loan at a 7.25% interest rate, although rates are much lower than that now. We're down to the high 5s, low 6s. We'll show you that in a second. Either way, this is a perfect example of what this will do to their mortgage payment, right? So the principal and interest payment on this mortgage, $4,877. With the 3-2-1 buy down, they're going to save $1,360 a month. It's going to bring that principal and interest payment to $3,517, right? So $3,500 is a lot easier to stomach than $4,800. And then in this first year, they're going to save $16,322 in monthly payments. That's amazing. In year 2, they save $929 a month for a total of $11,150 in savings. And then in year 3, $475 a month for a total of $5,700 in savings. So all in all, they will save $33,176 in payments in the first 3 years. And why this is so important is we know rates are going to come down. Even the Federal Reserve on their recent dot plot map showed that they expect rates to come down in the coming years. They're going to lower rates. And that's with inflation high, and they're being very conservative right now. So the rates will come back down. So that's why this product is actually perfect, because it allows the buyer to have lower rates for the first 3 years, or we'll look at a 2-1 buy down next. But that's why this is such a great product. To me, this is the best product out right now and the best use of your money as a seller. Rather than dropping the price $50,000 or $100,000 off the purchase price, right? If this loan amount's $715,000, this is probably an $800,000 house. If you take an $800,000 house and you drop the price to $750,000, that's not going to have as much sizzle as being able to drop their interest rate by 3% in that first year. Trust me. So it'll save your seller more money too if you're a listing agent or if you are planning on selling your house. This is a better way to save the buyer money rather than dropping the price of the house. If you drop the price by $50,000, you're only going to save them about $300 a month on a $50,000 drop, when they could save $1,300 a month in the first year. And this is where they really want the savings, is in the first years. You can always refinance to a lower fixed rate after that. And this money doesn't go to waste if you don't use it all. Let's say you decide to refinance in year 2. Well, all that extra money is actually going to get applied back towards principal to lower your loan amount. So it's not a waste if you refinance early as well. So I wanted you to know that. So a 2-1 buy down is the same as a 3-2-1, except the first year it's going to drop by 2%, second year by 1%. So in this example, they're still saving $930 a month for $11,150. Second year, $5,700 a month. I mean, $475 a month for a total of $5,700 for the year, right? So a total savings of $16,854. Then again, this could save your seller more money, and the buyer would be a lot more happy if you could just drop their monthly payment, right? Because this is going to have a larger effect than dropping the price by $20,000. If the seller drops the price by $20,000, or if you're the buyer representing a buyer as a realtor, if your buyer knocks off $20,000 off the price of the house, it's only going to save them $140 a month. I'll show you in a detailed example soon. So it's much better to apply this in a short-term buy down and in a temporary rate buy down. As long as you're buying a primary or secondary, you can't do it with investment property. On a 1-0 buy down, this lowers your rate by 1% for the first year. I'll cover this for your client. Okay? Fantastic ways to get a lower rate and make it more comfortable to enter that home. Then the permanent buy down. A permanent buy down lowers the interest rate of the loan. Any party on the loan can contribute to this, the realtor, lender, buyer, or builder. And this will mainly be used when dealing with investors, as they are not able to take advantage of the temporary buy down options. So temporary buy downs are only offered for primary and secondary homes at this time. So this is what a permanent buy down looks like. On a 30-year fixed program, these are the current rates. You can see a par rate's right here. Really, we would say a par rate's at about a 6.25, because we could get this covered for you. And then anything after that, this is the cost of the buy down. To buy it down to here, this is what the principal and interest would be, right? So this is the sweet spot right here at the 6.25. Just because, look, it costs you an extra $3,100 to save. What is that, like $50 a month? It's not really worth it. But this is a sweet spot. And over here, 10-6 ARM. This is the best product right now. Let me pop myself out to the side so you can see this. See, that par rate, 5.75, and then small buy down would get you all the way to 5.25, right? So if you take that 5.25 and then you get a 3-2-1 buy down on top of that, you can literally start with a 2.25% interest rate. Because we can, at CMG Home Loans, we can combine the ARM with the 3-2-1 buy down. Not many banks are doing that yet. So we are doing that. We're combining the two. That's going to be the best product available at this time. So here's an example. 20% down on an $800K list price, right? So this is the base scenario. This is if you get paid full price. Almost nobody is doing this right now. At the very least, I'm seeing something like this: $20,000 off the purchase price. So that $800K house you got for $780, how much did you win? You saved $139 a month. Like I said earlier, it's going to save you about $140 a month. 20% buy down with that 2% permanent buy down, that's going to get cost about $16,000. This is going to save you $364 a month. So it costs less, saves you more. This is why it's important to know these best strategies, right? Not just to ask for a bunch of money off the price of the house. It's not about it's really about the lowest cost of borrowing money over a period of time. So this could be good, especially if you're long term. But why this is the best option, I believe, it's going to save you the most money off the bat. Now let's look at this over 60 months. So this is over 5 years, right? So this 2-1 buy down is not going to save you that much over 5 years because it's really only saving you for 2 years. So you're getting this entire amount of money in 2 years. So this permanent buy down is going to save you more in the long term. And then if you just got 20 grand off the purchase price, this is all you've saved in 5 years, right? So you can see that both of these strategies are going to be better than lowering the price of the house by $20,000. Okay? But this is why I think that the temporary buy down is better, because you're going to save more in a shorter period of time. This is a 24-month analysis. So this is over 2 years, right? $20,000 off the price of the house, you save $2,200. $16,000 in permanent buy downs, you're going to save about $14,000. And then if you do the temporary buy down, you're going to save almost $20,000 in 2 years, which is a lot better. And you can refinance after this to a lower fixed rate. In this scenario, you've committed to that rate. So you do a permanent buy down. There's a break-even point on this buy down cost, right? So after 2 years, you still haven't broke even. Obviously, this costs $16,000. You save $14,000 so far. So how much can a seller pay towards closing costs? Conventional loan, less than 10%. Seller can contribute 3% towards closing costs. 10 to 25%, they can contribute 6%. If anybody does more than 25% down, they can get up to 9% in seller contributions. I've never seen it go that high or a seller willing to give that much, but I've seen both of these used. On an investment property, it's important to know the max seller contribution is only 2%. And then at FHA, you can get up to 6% seller contribution. So that's a really good product. And VA up to 4%, USDA up to 6%. If you need a copy of this, just send me an email, shoot me a text. I can send you one of these over so you have it, a little cheat sheet. What is an adjustable rate mortgage, and is it right for you? So an adjustable rate mortgage is what you'll commonly you'll hear called an ARM loan. So ARM stands for adjustable rate mortgage, and it's a home loan with a variable interest rate. And with an ARM loan, the initial interest rate is fixed for a period of time, either 3, 5, 7, or 10 years. After that, the interest rate applied to the outstanding balance resets periodically, normally every 6 or 12 months. And the rate can decrease or increase at each reset based on the current market. So the options available that I have are the 3-6, 5-6, 7-6, and 10-6 ARM. And what this means is the 3, the first number is how many years the rate is fixed for. Second number is how often it's adjusted. So a 3-6 means it's fixed for 3 years, and then it adjusts every 6 months after that. My favorite product right now is this 10-6 ARM because it's fixed for 10 years, which covers what the average time that most people are in a house is only 5 to 7 years. So a 10-year fixed covers you for 10 years, which is a good portion, right? And then it adjusts every 6 months after that. The reason why I like this one is it's almost the exact same rate as a 7-6 and a 5-6. So this gives you a little more comfortability knowing that you're fixed for 10 years. Let me jump back into this mode. So what is an ARM? It's a mortgage with an interest rate that rises and falls with the market at certain points throughout the loan term. Adjustable rate options come in various terms. The term structure is represented by the number of years your rate will be fixed and how often the rate will be adjusted after the fixed period. When to consider an ARM? You're looking to purchase a larger home. You're planning on living in the home for less than the initial fixed period, which is most people, by the way, like I just said. You are expecting to get a raise or switch to a higher paying job during the introductory period. Or you're looking for a cheaper way to break into home ownership. Now, in a time like this with a rising interest rate environment, that's actually when the ARM loan was invented in the 1980s, when rates were in the teens, over 15%. So at that time, everybody wanted to get the better deal. Adjustable rate mortgage allows the bank to offset some of that risk, right? So the bank's not taking on all that risk of a fixed rate for 30 years. So they offer you a slightly lower rate because they're only at risk for that first 10 years. And then the mortgage rates can be adjusted after that. So that's why this is a great product and a good way to get into that house with a little bit lower rate. So education, marry the home, date the rate. When we're in a high rate environment and people are fearful to move forward with purchasing a home, what we need to do is make them realize that it's actually creating an opportunity they always wanted. Help them find that home of their dreams, and we'll take care of the rest. With all the tools we have available, we can get them the lower rate right now and refinance lower into a permanent low rate at no cost to them. We're offering free refinances. Here's my refinance coupon. I send this to all your buyers. You can refinance, and we'll waive all the lender fees. This is good for 5 years. We know for a fact that rates are going to come down in the next 5 years. They're actually probably going to start coming down at the end of next year, and then trend down even more the year after that and the year after that. So this is a great way to get a lower rate for that introductory period, right? Get that 2-1, that 3-2-1 buy down, and then boom, when the rates come down, we're going to refinance you to a lower fixed rate. 30-year mortgage analysis. As you can see here, this was the last time we had high inflation, 70s and 80s. Rates just went up, right? And then once the inflation peaked and they started coming down, the rates have been in a downtrend ever since, basically a 40-year downtrend. And then with inflation spiking, the Federal Reserve's hiking rates only to slow down inflation. But we've seen that inflation peaked in the summer at 9.2% and has been coming down ever since. The most recent reading was 7.1%, so that's fantastic. Inflation's coming down. I checked oil this morning. It was at $75 a barrel. We saw inflation, oil as high as $140 a barrel over the summer. So that's obviously going to bring down the price of everything. Everything is transported by gas and oil, right? So when the price of oil comes down, the price of everything comes down. So we can be a little forward looking. The CPI is a lagging indicator, and we can say, you know what? Trueflation is another indicator I track. Trueflation is already under 6%. So I can tell you that CPI is going to continue to come down. Pretty soon the Fed's going to stop hiking rates. Maybe they have 3 more quarter point rate hikes. I don't think they'll do any more 70s or 50s. And then we'll be back to quarter point rate hikes, and then they're going to stop soon after that. We're already at 4.5% Fed funds rate, and their target, the average target of all the Fed members, is about 5.25. So that's 3 more rate hikes of 0.25% max, and that's what I think they'll do. I think they'll do 2 to 3 more rate hikes at 0.25% and then stop. That does not mean they're going to start cutting rates, though. So that's different than what most people think of a pivot is. It's just going to be a pause, and then they're going to leave them there for most of next year, and until they see inflation starting to come closer to that 2% target that they have. And then they'll start to actually cut rates to stimulate the economy after that. So, what are the pros and cons of buying a home in today's market? The pros: seller paid closing costs, seller paid rate buy down, price negotiation, no need for an appraisal waiver. The last 2 years, you had to put an appraisal waiver, or almost every contract I got had an appraisal waiver because the buyer was offering well over the list price, and the agent didn't want to deal with it if it didn't appraise, because a lot of them weren't appraising. Then the buyer had to pay the difference of that offer and the actual appraised value. So there's no need for that anymore. Contingency contracts, those are actually allowed again. You need to sell your house before you buy another, you can put in a contingency contract. Longer contract to close. More inventory of homes. This is huge right here. Like I said earlier, you can actually find your dream home right now. There's a lot more inventory on the market. Last I checked, there was about 13,000 homes for sale in the greater Houston area. That's fantastic. Less buyer competition. This is what allows you to get the seller paid closing costs and the seller paid rate buy down. If you wait for a year or two for the rates to come down, all these deals are going to go away because the buyer competition will come back, right? The masses of buyers are waiting for rates to come down. So if you want to wait to buy with the masses, all these deals are going to go away, right? And then the only pro will be you won't have higher rates, okay? No need to pay cash or high down payment to be competitive. The only con right now is the rates are higher. So I can tell you what, you want that 3% rate, all of this stuff moves over to this side, okay? That's basically the way it works. When rates go low, it comes over here to the pros, and then the cons is this entire list because it gets extremely competitive again like we saw the last couple of years. So actually right now is a fantastic time to buy. I will be looking to buy in the coming months. Why use CMG Home Loans? We're the #1 non-depository mortgage lender. Did $1.2 billion in loans, and we serve 4,255 families. This is just in the Austin area, Austin branches, the Texas area. These are all of our loans. We have every loan that any other bank has. This is what most banks have, this little small section here. And then we also have the bank statement loans, the investor cash flow, builder rate locks up to 12 months, Seth Gold Star, right? We got the down payment assistance, the T-Shack for teachers. We got the teacher loan, the Home Sweet Texas loan. We have the doctor loan program up to 100% financing. These are our specialty products that nobody else has. Home Funded. You can use this product to crowdfund your down payment. That's right. We can send you a link. You can post this link on your social media, send it out to your through an email blast. Let's say you're having a wedding or you're graduating college or something like that, a big event, a birthday party, whatever. Instead of asking everybody for wedding gifts or graduation gifts, you can send them a link, ask them to donate to your Home Funded, and you can crowdfund your down payment and closing costs with no gift letters. Absolutely amazing. We're the only bank that has that. This is the biggest loan we have right now, all in one loan. This is a first lien HELOC. It's the only loan of its kind, and we are the only bank that has this product. It allows you to purchase a home with a HELOC. This one here takes about 30 minutes to an hour to explain, and then you'll probably have some questions about the details after that. This is the most powerful loan known right now. As far as I'm concerned, this loan's absolutely amazing. I'll do a whole presentation on this separately. If you have any questions, just give me a shout. And then here's a bunch of other great stuff we have. These right here, this is a page of the reasons why I would never leave this bank. Here's some flyers that I can make for you. 3-2-1 buy down would get you a 2.75% interest rate on that 10-6 arm with the 3-2-1 buy down, right? So rather than your seller dropping the price by $50,000, $30,000, let's check this out. Here's another one I made for another realtor I work with. This is if your seller doesn't want to do the full 3-2-1 buy down because it has a higher cost. We can start with a 2-1 buy down and start to advertise these lower rates. This is going to sell your house faster than waiting for a price drop, or like I said, $20,000 saves them $140 a month. Or you can start to, we can drop their rate into the 3s with a slightly higher rate buy down. We could drop them into the 2s. Absolutely amazing time. Join my YouTube channel. You can subscribe to my YouTube channel. I have a ton of content on real estate, finance, investing, trading, weekly wrap up. I'm going to be making videos constantly. My goal is to provide a wealth of education and to answer all the questions that me or my realtor referral partners get asked. I basically want to have a database of information here. So subscribe. You can click a bell for notifications and you'll be notified when I make a video. Here's my contact information, Senior Loan Advisor at CMG Home Loans. Here's my phone number, my email address, and my website where you can apply for a home loan. Questions and answers, send me an email, give me a call, shoot me a text, whatever works best for you. I'm happy to answer your questions. And thank you so much for joining us. I really appreciate your time, and I look forward to working with you on any future transactions you have. Have a wonderful day.